Hello there, and welcome back. Chris here, bringing you another survival guide. Have you ever wondered if there are times when we probably shouldn't be trading, or if we are trading, we better know how to safely navigate them? I'm referencing times of geopolitical instability or just economic instability, things that we're all experiencing all over the world right now. These are all things that are important to understand in terms of how to identify these types of scenarios, as well as if we choose to navigate through the markets during these times, to understand some of the tips that can allow us to more safely do so. But without further ado, let's dive on into it and learn about some uncertain and unstable times. Market history shows us clear trends. We've seen that markets move in cycles. Every decade or two, we're experiencing some sort of serious crisis, whether it's geopolitical tension, local conflicts, global instabilities, or some type of financial crisis. Most of the time, the effects of these events ripple through the entire world economy, affecting trade, devaluing currencies, causing supply disruptions, increasing inflation levels, and so much more. The magnitude of these events can vary, and their overall impact can last anywhere from a couple days to several years. So the first thing that we're going to do is we're going to talk about the different types of destabilizing events, these different things that can happen that can cause everything we just mentioned to occur. Many traders mistakenly believe that financial markets are affected only by intrinsic events, including a country's or a company's default, a Fed or ECB interest rate announcement, and all of those things. However, the truth is that financial markets can be affected by events that don't even seem to be relevant, at least at first. The same goes for the magnitude of these events. It doesn't take a war or global financial meltdown to destabilize the markets. Often, even small-scale events can have significant consequences if we know where to look. The first one is global conflicts, so the first of the ones that we'll discuss that can cause these destabilizing events anyway. Global conflicts. So we have terrorism, armed conflicts, civil unrest, international economic and political sanctions, embargoes. These are just many examples that are going to directly or indirectly affect the financial markets on the global level. So, for example, wars have led to the most significant drawdowns to global markets in the past if we were to go backwards. These are the things that hit us the hardest, or at least thus far they have. Germany attacked Czechoslovakia in 1939 and France in 1940, and when this happened, the S&P fell by 20.5% and 25.8% the second time over. On the day after Pearl Harbor attack, the index fell 11%. During the 1973 oil crisis, the S&P nosedived over 17%. The point is, global conflicts are going to hit the market hard, and the harder the market is hit is going to be correlated to the degree of the event that's happening. If it's two smaller countries warring with each other and the rest of the world is not involved, naturally we're going to expect the impact to be a little bit less than if we have a massive world war. Next up, we have high inflation periods. Inflation kind of works in the shadows, and it usually doesn't directly or immediately affect one's capital, or at least that's how many of us seem to think. However, it is in fact one of the most devastating events for one's financial health. An example would be in June of 2022, the inflation in the US reportedly hit 8.6%. This means an individual with $10,000 in capital will lose $860 worth of purchasing power in a single year. Scale this up from someone with a $100,000 portfolio and you get the picture. For a trader or for an individual that's trying to build up a retirement, inflation is always a scary thing. Inflation can be fueled by many different triggers, including supply-demand instabilities, labor market disruptions, economic slowdown, monetary policy developments. The list really kind of goes on and on. Inflation rates can vary, but the higher they are and the longer longer they last, the more devastating their effect is. For example, the most significant inflation event ever measured was in Hungary after World War II. The country experienced hyperinflation with a monthly rate of 41.9 quadrillion percent. And yes, I did say that correctly, 41.9 quadrillion percent. In July 1946, as a result of this, prices doubled every 15.3 hours. To protect their portfolios against high inflation periods, traders will usually choose assets designed to hedge against the loss of purchasing power. Alternatively, instruments with high probability of generating additional income and increasing in value in the face of rising prices are always good places to look. Many assets have historically performed well in periods of high inflation, so it's not something that we should all panic about for our long-term portfolios, but we do need to have a plan. Inflation is often referred to as a portfolio killer. That is why trading during high inflation periods requires mastery and understanding of the asset classes that perform best when purchasing power is suffering, especially when it happens on a global scale and there's really nowhere to hide. Next up, we have nightmare fuel for most traders. That is the Black Swan events. Black Swan events hit hard and are unexpected, which always seems to catch traders off guard. Such events might include weather anomalies impacting crop production, or a one-off flash crash that tumbles the market for a few minutes, or maybe a global pandemic, or other events that traders just simply cannot prepare for. That's what falls under the definition of a Black Swan event. In March of 2021, the Ever Given ship got stuck in the Suez Canal, as many of us are aware, and this disrupted the busiest and most critical trade route in the entire world. The blockage of the vital waterway disrupted global supply chains and the delivery of goods from China and South Asia to Europe. It also disrupted crude and refined product delivery from the Persian Gulf and India to Europe. This cost the trade world as a whole over $400 million per hour. This is a serious problem. The ship left the canal a few months later in July of the same year, but the impact was absolutely massive. It just depends on where you want to look to see the effects. Or another example of a Black Swan event would be the 9/11 terrorist attacks, which led to a very sharp stock market plunge and wiped out over $1.4 trillion in value from U.S. markets. Throughout the following week, the Dow Jones Industrial Average lost 14%, while the S&P 500 and the Nasdaq losses were around 11.6% and 16% respectively. Due to the growing interconnectedness of global markets, investors and traders today must be aware of the increasing importance of Black Swan events and their potential implications on portfolios. The bottom line is that even if a particular factor doesn't indicate any relevance to your trades at first, through its links to other sectors and industries, your positions might be impacted and you should be aware of this. Good news! There are some tips that we can keep in our mind in order to better navigate or decide not to navigate when these events occur. The first is that if you're a beginner, you might want to consider hedging or exiting your position entirely when these events happen. Many traders will tell you that the key to winning is knowing when to cut losses or knowing when to avoid them entirely. The passive approach is to close your positions and head for the exit when these Black Swan events occur. It may not sound like the most exciting option, but if you don't feel you have the event mastered, or if you don't feel you're about to succeed in all the ways you'd like to, by not getting yourself involved at all, you can simply avoid any of the potential downsides that might come with trading a Black Swan event. Then we have trade only if you have enough capital. While turbulent market periods can open many opportunities, it is better to take a more passive approach if you aren't confident in navigating the uncertainty or you are operating on a limited capital account. Bear in mind that this is usually a high-risk environment regardless of how much money you have, but the truth of the matter is a larger account is going to allow you to survive all of the effects of a very volatile market in a more comfortable manner than perhaps a smaller account. Now, on the other side of that coin, a larger account does stand to lose more money. It's important to understand the benefits and the downsides to everything. You should consider the worst case scenario of losing your entire portfolio. As dark as that sounds, if you've never done that, it could be a very valuable thing for you to stop and consider that option, and always consider that option before you step forward engaging in a position. You don't want to fear lock yourself, but it's important to be down to earth and not live in a fantasy where you're telling yourself that you'll never lose. The next thing is to just simply stay calm and relaxed. If you're not a beginner trader and you feel you have enough capital that you're comfortable risking to march forward during these black swan events, the next thing to do is to just stay calm and relaxed. Think about everything before you do it. Manage every trade like a tactical decision. There should always be a reason as to why you're getting into the trade and a predetermined reason as to why you will close the trade early, whether it be for profit or whether it be for loss. You want to stay calm and relaxed. Don't bring your emotions into the picture. This is arguably one of the most difficult things for us as traders to do, but unfortunately it is something that will benefit us if we learn to control our emotions and stay calm and relaxed. At the end of the day, there is no right or wrong answer for whether or not it's okay to trade black swan events. For some traders, they absolutely love them and view them as another location where they can pull profits out of the markets. For others, they absolutely hate them. It's up to you and your strategy to decide if your strategy and your trading style and who you are as a trader meshes well with those types of emotions and those types of events. Do you respond well to that type of stimulus, the unknown? Do you adapt quickly? If you do, then maybe trading them is for you. There are things that all of us can do to improve our chances as we trade through these events, like enhancing our security as traders. And what I mean by that is making sure we have stop losses and take profits set ahead of time. We can also make sure that we're only trading with capital that we can afford losing, especially when we're trading in these types of wild events. It's important to understand that concept. And on top of that, it's important to always keep our eyes on the bigger picture. Stay out of the emotional seat and stay in control of what's happening and think algorithmically. Good luck out there. Happy trading. I'll see you all very soon.